Most people believe money is money because it has value. They work for it, they save it, they fight for it, they spend their whole life chasing it. But almost nobody ever stops and asks one simple question. What actually gives money its value? Because today when you hold a dollar bill in your hand, it feels real. It has a number printed on it. It has government symbols on it. It has the face of a president on it. Banks accept it. Stores accept it. The whole world accepts it. So naturally people assume the dollar must be backed by something powerful. Gold, silver, oil, a secret vault, some solid foundation underneath the system. But the truth is much stranger. Today's dollar is not backed by gold. It is not backed by silver. It is not backed by anything physical that an ordinary person can redeem. It is backed by confidence. It is backed by debt. It is backed by the belief that tomorrow, everyone else will still accept it. And the day this happened was not ancient history. It was not hundreds of years ago. It happened in 1971, when one decision changed money forever. That was the day the dollar stopped being real money. And almost nobody understood what had just happened. Before 1971, the world monetary system had a very different foundation. After World War II, America came out as the strongest economic power on earth. Europe was damaged. Japan was rebuilding. Much of the world had been financially exhausted by war. America, on the other hand, had factories, military power, and most importantly gold. A huge amount of the world's gold sat in American vaults. So after the war, the global financial system was built around the US dollar. Other countries would link their currencies to the dollar, and the dollar itself would be linked to gold. The promise was simple. Foreign governments and central banks could exchange dollars for gold at a fixed rate. 1 ounce of gold was priced at $35. This gave the world confidence. The dollar was not just paper, it was a claim on something real. If a country held too many dollars and started doubting America, it could theoretically say, fine, give us gold instead. That one promise made the dollar the center of the global economy. But there was a hidden weakness inside the system. America had to act responsibly. Because if the dollar was tied to gold, then America could not print unlimited dollars without creating a problem. Every extra dollar was supposed to represent trust in America's gold backing. But power changes behavior. Once America realized the whole world needed dollars, temptation appeared. The government wanted to spend more. More military bases. More foreign commitments. More social programs. More wars. More global influence. And slowly the number of dollars outside America started growing much faster than the amount of gold America actually had. At first people did not panic. Because America was trusted. America was seen as stable. The dollar was seen as safe. But behind the scenes, a dangerous question was growing. If every foreign country holding dollars asked for gold at the same time, could America actually pay? The answer was becoming uncomfortable. No. By the 1960s, pressure was building. The United States was spending heavily. The Vietnam War was draining money. Domestic spending was rising. More dollars were being created and sent around the world. Foreign governments started noticing something. There were too many dollars and not enough gold. And when people notice weakness in a financial system, they do not wait politely. They start testing it. Some countries began asking for gold instead of dollars. France especially became famous for challenging the system. French leaders understood that if America could print paper while other countries had to give real goods in exchange, then the system was giving America an enormous advantage. Imagine this. One country can create dollars. Other countries must produce cars, oil, machines, food and labor to get those dollars. That is not just money. That is power. So the pressure kept rising. Gold started flowing out of American reserves, and America faced a choice. Either stop printing so many dollars and defend the gold link, or break the promise. This is where the story becomes important, because on August 15, 1971, President Richard Nixon went on television and announced a decision that would change the world. He said the United States would temporarily suspend the convertibility of the dollar into gold. Temporarily. That word matters. Because many of the biggest changes in financial history begin as temporary emergency measures, temporary taxes, temporary controls, temporary suspensions, temporary crisis tools. But once governments discover a new power, they rarely give it back. And this temporary suspension became permanent. From that moment forward, the dollar was no longer redeemable for gold. The final link between money and hard asset had been cut, and the modern fiat money system was born. Fiat money means money by decree. Money because the government says it is money. Money because the system accepts it. Money because the law, banks, markets, and global trade continue treating it as valuable. But this created a completely new world. Before this moment, money had a chain attached to it. Gold was the chain. It limited how far governments could go. It did not make the system perfect. It did not stop manipulation. It did not stop banking games. But it created a boundary. After 1971, that boundary was removed. Now the system could expand through credit, debt, and central bank policy. Money became flexible. But flexibility for governments often means pressure for ordinary people. Because when money can be created more easily, the first people closest to the source of new money benefit the most. Banks, governments, large institutions, financial markets, asset owners. They receive the new money before prices fully adjust. But regular workers receive it later, after the cost of living has already moved. This is one reason why people feel like they are working harder but falling behind. It is not always because they are lazy. It is not always because they made bad choices. Sometimes the money itself is changing underneath them. After 1971, the world entered a debt-based financial era. Instead of money being tied to gold, money became tied to borrowing. Debt became the engine. Governments borrowed more. Consumers borrowed more. Corporations borrowed more. Banks created more credit. Asset prices started becoming a major part of the wealth system. Stocks, real estate, bonds, financial instruments. The economy became less about saving real money and more about managing access to credit. This is where the hidden wealth transfer begins. Because inflation does not hit everyone equally. A rich person owns assets. A poor or middle-class person mostly earns wages. When more money enters the system, assets often rise first. Homes become more expensive. Stocks rise. Land rises. Businesses rise. But wages usually move slower. So the person who already owns assets gets richer. The person trying to buy assets gets pushed further away. This is why a house that one income could buy decades ago now requires two incomes, debt and years of pressure. This is why people can make more money on paper but feel poorer in real life. Because the number went up but the value of the money went down. That is the part most people are never taught. They are taught to ask, how much money do I have? But the better question is, what does this money buy? Because if your salary doubles but food, rent, energy, healthcare, education and housing triple, you did not get richer. You got trapped in a bigger number. And this is why 1971 matters. It was not just a technical banking decision. It changed the relationship between people and money. Before, money was at least connected to something scarce. After, money became connected to policy. And policy is controlled by people in power. Now, whenever there is a crisis, the system has a familiar response. More liquidity, more stimulus, more borrowing, lower rates, higher rates, emergency programs, central bank action, debt expansion. Each crisis is solved by creating a bigger financial structure than the last one. But the question is never fully answered. If debt keeps growing faster than real productivity, who pays? The answer is usually hidden inside inflation, taxes, currency weakness, and reduced purchasing power. The average person does not get a bill in the mail saying, "Congratulations, you are paying for decades of monetary expansion." Instead, they feel it slowly, at the grocery store, at the gas pump, in rent, in medical bills, in tuition, in the price of a used car, in the fact that saving money feels harder every year. That is how the system takes value quietly. Not always through direct confiscation, sometimes through dilution. Think of it like this. Imagine you own a glass of juice. Then someone keeps adding water to it. The glass looks full. The volume is still there, but the flavor is weaker. That is what happens when a currency is expanded too much. You still have dollars, but each dollar carries less strength. And the genius of the system is that most people blame themselves. They think they are bad at budgeting. They think they just need to work more. They think prices are rising randomly. But very few people connect it back to the structure of money itself. Now, to be fair, the post-1971 system also gave America huge advantages. It allowed the US to finance global power. It allowed deep credit markets. It helped create the modern financial world. It made the dollar even more central in global trade. Oil, commodities, debt markets, international banking, much of it continued revolving around dollars. But this also created a strange paradox. The dollar was no longer backed by gold. Yet the world still needed dollars. Why? Because global trade was built around them. Countries needed dollars to buy oil. Governments held dollar reserves. International loans were often priced in dollars. Global markets trusted US Treasury debt. So even after gold was removed, demand for dollars remained strong. This gave America what some people call an extraordinary privilege. America could borrow in its own currency. It could run deficits. It could export dollars. It could finance influence through the very system it controlled. But every privilege creates dependency. The world became dependent on dollars. America became dependent on debt. And ordinary people became dependent on a currency that loses purchasing power over time. This is the real hidden story. 1971 did not make money disappear. It made money political. It made money elastic. It made money something that could be expanded, managed, manipulated, and weaponized. And once money became flexible, the entire economy changed. Companies started focusing more on financial engineering. Governments became more comfortable with deficits. Consumers were encouraged to borrow. Banks became more powerful. The stock market became a national obsession. Real estate became a wealth machine. And saving cash slowly became a losing strategy during inflationary periods. This is why older generations often say, back then, one salary could support a family. They are not imagining it. The structure was different. The money was different. The debt levels were different. The cost of housing relative to income was different. The financial system had not yet expanded into the giant machine it is today. But after the gold link broke, the machine had room to grow. And grow it did. Debt grew. Asset prices grew. Government spending grew. Financial markets grew. But so did inequality. So did pressure on workers. So did the feeling that no matter how much people earn, they are still behind. That is why the 1971 decision is not just about gold bugs or economists. It is about every person who works for money. Because if you do not understand what money is, you cannot understand why life feels more expensive. You cannot understand why assets keep rising faster than wages. You cannot understand why governments can be deeply in debt but still keep spending. You cannot understand why central banks have so much power. And you cannot understand why the system always seems to protect itself first. This is the part people are not supposed to think about too deeply. Because once you understand that money is not neutral, you start seeing the world differently. You start seeing inflation differently. You start seeing debt differently. You start seeing taxes differently. You start seeing wars differently. You start seeing global power differently. You realize money is not just a tool. Money is a control system. Whoever controls the money controls the rules. And whoever controls the rules can shape the future. This does not mean every dollar is worthless. That is not the point. The dollar is still powerful because the world still uses it. The US economy is still massive. The US military is still powerful. US financial markets are still deep. The dollar system is not weak just because it is fiat. But it is fragile in a different way. It depends on confidence. And confidence is invisible until it breaks. A gold-backed system depends on reserves. A fiat system depends on belief. Belief that the government will manage responsibly. Belief that debt will remain sustainable. Belief that inflation will not destroy purchasing power. Belief that other countries will keep accepting the currency. Belief that tomorrow's dollar will still be worth enough. And that is the dangerous part. Because once money becomes belief, psychology becomes part of the system, trust becomes currency, and if trust starts cracking, the system has to work harder to protect itself. This is why central banks speak carefully. This is why governments manage narratives. This is why markets react to every word from financial officials. Because the modern system runs not only on money, it runs on confidence in money. So when people ask, what happened in 1971? The simple answer is, America closed the gold window. But the deeper answer is, the world moved from hard money discipline into a credit-based empire, a system where debt could expand almost without limit, a system where money could be created without direct gold backing, a system where wealth would increasingly flow toward those who owned assets, controlled credit, and understood monetary rules. And ordinary people were never properly told what changed. They were just told to keep working, keep saving, keep borrowing, keep consuming, keep trusting. But history shows that every money system has a lifespan. Every empire believes its currency is permanent. Every financial order feels normal to the people living inside it. Until one day it doesn't. This is why the story of 1971 matters now more than ever. Because today, debt is everywhere. Government debt, corporate debt, consumer debt, student debt, mortgage debt, credit card debt. The entire modern economy is built on promises about the future. And the question is not whether the system can continue tomorrow. It probably can. The question is whether the average person understands the game they are living inside. Because if you think money is just money, you will play by the surface rules. But if you understand that money is a system, you start asking better questions. Why do prices rise? Why do assets inflate? Why does debt keep growing? Why do crises always end with more money creation? Why do the people closest to the financial system always seem to win first? And why was the most important money decision of the modern world explained as a temporary measure? That is the story they rarely tell clearly. The dollar did not stop being used in 1971. It became more powerful in some ways. But it stopped being what many people thought it was. It stopped being a direct claim on gold. It became a claim on confidence. A claim on government credibility. A claim on future productivity. A claim on the belief that the system would continue. And that is the hidden truth. The dollar did not die in 1971. It transformed. From money backed by metal, into money backed by power. And once you understand that, modern history starts to look very different. Wars look different. Debt looks different. Inflation looks different. Markets look different. Even your paycheck looks different. Because the real question is not only how many dollars you earn, the real question is, who controls the value of those dollars after you earn them? And that question leads to a much bigger story. Because 1971 was not the end. It was the beginning of the financial world we live in today. A world where money can be created faster than wages. Where asset owners move ahead while savers fall behind. Where governments borrow from the future to survive the present. Where confidence is treated like a reserve asset. And where the average person is expected to trust a system they were never taught to understand. So the next time someone says, the dollar is just money, remember this. Money is never just money. Money is history. Money is power. Money is trust. Money is control. And in 1971 the control system changed forever. That was the day the dollar stopped being real money. And the world is still living inside the consequences.